In 1929, when the banks started failing, people didn't get a warning. They woke up one morning, walked to their bank, and found the doors locked. Their life savings gone, not stolen, not lost in the stock market, just gone. Trapped behind locked doors they couldn't open. 9,000 banks failed between 1929 and 1933. 9,000. If you had $10,000 in your account on Monday, by Friday you had nothing. No insurance, no bailout, no government guarantee. Your money simply ceased to exist. And here's what nobody tells you about that era. The people who lost everything weren't reckless. They weren't gamblers. They were teachers, factory workers, small business owners. People who did everything right, saved their money, trusted the system, followed the rules. The system failed them anyway. Now fast forward to 2025. Your money sits in a bank account. You see the number on your screen. You assume it's safe. FDIC insured up to $250,000. The government guarantees it. Nothing like 1929 could ever happen again. But what if I told you that your money is already trapped? Not in the future, right now. And the mechanism that's trapping it is far more sophisticated than locked bank doors. It's invisible. It's legal. And when the 2026 crisis hits, you're going to discover that the number on your screen and the actual money you can access are two very different things. This isn't speculation. This is pattern recognition. And once you see how 1929 unfolded, how the trap was set, how people discovered too late that their money was gone, you'll understand exactly why 2026 is going to be worse, not similar. Worse. Let me show you how the trap works. Then and now. Before we get into the mechanics of how your money gets trapped, you need to understand what a bank actually is. Not what they tell you it is, what it actually is. You think a bank is a safe place that holds your money. It's not. A bank is a business that borrows your money and lends it to someone else at a higher interest rate. The difference is their profit. When you deposit $10,000, the bank doesn't put it in a vault with your name on it. They keep maybe $1,000 in reserve and lend out $9,000 to someone buying a house or starting a business. This is called fractional reserve banking, and it's been the foundation of the banking system for over a century. It works fine when everything is stable, when people aren't all trying to withdraw their money at once, when borrowers are paying back their loans, when confidence in the system remains high. But when confidence breaks, when people rush to withdraw their money, the system collapses instantly because the money isn't there. It never was. That's what happened in 1929, and it's what's being set up right now for 2026. Let me walk you through exactly how it happened then, because the pattern is repeating with terrifying precision. The 1920s were a boom time in America. The economy was growing. The stock market was soaring. Credit was easy. Everyone was getting rich. Banks were lending aggressively, not just to businesses, to regular people. You could buy stocks on margin, putting down just 10% and borrowing the rest from your broker. If you wanted to buy $10,000 worth of stock, you only needed $1,000. The broker lent you the other $9,000. And as long as stock prices kept rising, it worked beautifully. You'd make money on the full $10,000 investment while only risking $1,000. People were borrowing to invest, borrowing to speculate, borrowing to get rich quick. And the banks? They were lending to anyone. Because loans were profitable. And as long as asset prices kept rising, the loans were safe. If someone defaulted, the bank could seize the collateral and sell it for more than the loan. This is the setup. Easy money. Excessive lending. Speculation replacing investment. Asset prices disconnected from fundamentals. Sound familiar? It should. On October 24, 1929, the stock market crashed. Black Thursday, panic selling, margin calls. Investors who'd borrowed to buy stocks were forced to sell to cover their loans. The selling accelerated. October 28th and 29th were even worse. Black Monday and Black Tuesday. The market lost 25% of its value in 2 days. Fortunes evaporated. Millionaires became paupers overnight. But here's what most people don't understand. The stock market crash wasn't the real crisis. It was just the trigger. The real crisis was what happened next, in the banks. After the crash, people got scared. If the stock market could collapse, what about the banks? Were they safe? People started withdrawing their money. Not everyone at first. Just the nervous ones. The cautious ones. But banks operate on fractional reserves. They don't have everyone's money. They have maybe 10% in reserve, and the rest is lent out. So when withdrawals increased, banks had to call in loans, demand repayment, sell assets to raise cash. But everyone was doing the same thing at the same time. Selling assets, calling in loans, trying to raise cash. Asset prices collapsed. Loans couldn't be repaid. Banks couldn't raise enough cash to meet withdrawals. And once word spread that a bank was struggling, everyone rushed to withdraw their money before it was too late. This is a bank run, and it's a death spiral. The more people withdraw, the weaker the bank becomes. The weaker the bank becomes, the more people withdraw. By 1930, banks were failing every week. By 1931, every day. By 1933, over 9,000 banks had collapsed. And here's the trap. When a bank failed, your money was gone. There was no FDIC insurance, no government bailout, no safety net. If you had $10,000 in the bank on Monday and the bank failed on Tuesday, you got nothing. Maybe pennies on the dollar if the bank's assets were liquidated, but usually nothing. People who had saved for decades lost everything in a single day. Not because they made bad investments, not because they were reckless, because the bank they trusted failed. Their money was trapped, and then it was gone. In 1933, Franklin Roosevelt became president. One of his first acts was to declare a bank holiday. He closed every bank in the country for 4 days. The official reason was to stop the panic, to give banks time to stabilize, to restore confidence. But here's what really happened. The government decided which banks would reopen and which wouldn't. They decided who got their money back and who didn't. If your bank was deemed solvent, it reopened and you could access your money. If it wasn't, it stayed closed and your money was gone. This is the trap. Your money isn't really yours. It's a liability on the bank's balance sheet. And when the bank fails, that liability disappears. The number in your account isn't money. It's a promise, and promises can be broken. Now let's jump forward to 2025. You think the system is different now, safer, more regulated. FDIC insurance protects you up to $250,000. The government won't let banks fail like they did in 1929. You're wrong. The trap is already set, and it's far more sophisticated than anything that existed in 1929. Let me show you exactly how your money is trapped right now. Today's banks operate on even thinner reserves than they did in 1929. The reserve requirement for most banks is effectively zero. The Federal Reserve eliminated reserve requirements in 2020. Read that again. Zero reserve requirement. Banks can lend out 100% of deposits if they want. In practice, most banks keep some reserves for operational purposes, but it's minimal. Maybe 3 to 5%. The rest is lent out or invested. So when you deposit $10,000, the bank keeps $300 to $500 and lends or invests $9,500 to $9,700. Your money isn't there. It's in someone else's mortgage, someone else's business loan, someone else's investment portfolio. You think FDIC insurance protects you. It does, up to $250,000 per depositor per bank. But here's what they don't tell you. The FDIC has about $125 billion in its insurance fund. Total bank deposits in the U.S. are over $18 trillion. Do the math. The FDIC has enough money to cover less than 1% of total deposits. If 2% of banks fail, the FDIC is insolvent. If 5% fail, the system collapses. But the government will bail them out, you say. They'll print money. They'll do whatever it takes. Maybe, but how long will that take? Days? Weeks? Months? And what happens to your money in the meantime? It's frozen, trapped, inaccessible. In March 2023, Silicon Valley Bank failed. The 16th largest bank in America collapsed in 48 hours. Depositors tried to withdraw $42 billion in a single day. The bank didn't have it. They'd invested deposits in long-term bonds. When interest rates rose, those bonds lost value. The bank was insolvent. The government stepped in, guaranteed all deposits, even above the $250,000 FDIC limit, prevented a full-scale panic. But here's what that event revealed. The system is fragile, extremely fragile. One bank run nearly triggered a cascade of failures across the entire banking system. And the government's response? They guaranteed deposits by creating new money, printing it into existence, expanding the money supply. And this is the modern trap. Your money isn't gone, it's just worth less, much less. Right now, in 2025, the conditions for a banking crisis are worse than they were before March 2023, and far worse than 1929 in some ways. Commercial real estate is collapsing. Office buildings are empty. Remote work has permanently reduced demand. Property values are down 30, 40, 50% in some markets. Banks hold hundreds of billions in commercial real estate loans. Many of those loans are underwater. The property is worth less than the loan amount. When those loans default, and they will, banks will take massive losses. Some will fail. Regional banks are especially vulnerable. They hold a disproportionate amount of commercial real estate debt, and they don't have the diversification or capital reserves of the big banks. When the first regional bank fails in 2026, and it will, depositors at other regional banks will panic. They'll try to withdraw their money, move it to bigger banks, move it to treasury bonds, move it anywhere that feels safer. But the money isn't there. It's lent out. It's invested. It's trapped in illiquid assets. The bank can't meet the withdrawals. It fails. The FDIC steps in. But there are too many failures happening at once. The FDIC fund is overwhelmed. The government intervenes, guarantees deposits, prints money to cover the shortfall. Your money is safe. The number in your account doesn't change, but the value of that money, it's been diluted, inflated away. Your $100,000 is still $100,000, but it buys what $70,000 used to buy, or $50,000, or less. This is the modern trap. Your money isn't confiscated, it's devalued, legally, invisibly, inevitably. If you're starting to realize that the safety you thought you had is an illusion, that the system is far more fragile than you've been told, then you need to understand what comes next. Because the 2026 crisis isn't just about banks failing, it's about the entire financial system restructuring, and most people won't see it coming until their purchasing power is cut in half. Subscribe to Economy Time Machine right now, because in the next few videos I'm going to show you exactly how to position yourself before the trap closes. Hit that subscribe button. The pattern is the same. Easy money, excessive lending, asset bubbles, a trigger event, bank runs, crisis. But there are critical differences that make 2026 more dangerous. In 1929, money was physical, cash, gold. If you withdrew your money before the bank failed, you had it. Physical possession. Today, money is digital, numbers on a screen. Even if you withdraw cash, it's a tiny fraction of the money supply. There isn't enough physical currency in existence to cover even 10% of bank deposits. Your money is trapped in the digital system, and the digital system can be controlled, frozen, restricted, with the push of a button. In 1929, the government let banks fail, 9,000 of them. It was brutal, but it cleansed the system. Bad banks died. Depositors lost money. But the system eventually stabilized. Today, the government won't let big banks fail. They're too big, too interconnected, too systemically important. So instead of letting them fail, the government will bail them out, print money, guarantee deposits, do whatever it takes to prevent collapse. But that money has to come from somewhere, and it comes from you, through inflation, through devaluation, through the invisible tax of currency dilution. In 1929, if your bank failed, you lost your money. It was gone. Brutal, but clear. In 2026, your money won't disappear. The number in your account will stay the same, but its value will evaporate. You'll still have $100,000, but it will buy what $50,000 used to buy. This is a more sophisticated trap, more insidious, harder to see, easier to deny. The pattern says the 2026 banking crisis is coming. The conditions are set. The fragility is obvious. The trigger could be commercial real estate defaults, a recession, a geopolitical crisis, or something we don't see coming. But it's coming. So what do you do? How do you protect yourself when your money is trapped in a system designed to fail? First, understand that diversification isn't just about stocks and bonds. It's about systems. Don't keep all your money in one bank. Don't keep all your wealth in the banking system. Second, recognize that cash is a position, but it's a depreciating position. If the government prints money to bail out banks, your cash loses value. You need assets that hold value when currency is debased. Third, understand the difference between liquidity and safety. A bank account is liquid. You can access it instantly, but that doesn't make it safe. Safety and liquidity are not the same thing. Fourth, study history. The pattern repeats. 1929 wasn't unique. 2008 wasn't unique. 2026 won't be unique. The mechanics change. The technology changes. But the pattern is always the same. Easy money, excessive lending, asset bubbles, a trigger, panic, crisis, bailouts, devaluation, every time. Your money is trapped right now, not in the future. Right now. It's trapped in a fractional reserve system that doesn't actually hold your money. It's trapped in a digital system that can be frozen or restricted. It's trapped in a currency that can be devalued at will. The number on your screen gives you the illusion of safety, but it's just a number, a promise, a liability on a bank's balance sheet. And when the crisis comes, when the banks start failing, when the government starts printing money to bail them out, you're going to discover what people discovered in 1929. The money you thought you had isn't really yours. It never was. The difference is, in 1929, people lost their money and knew it. The bank closed. The money was gone. Clear and brutal. In 2026, you'll keep your money. The number won't change, but its value will evaporate, and most people won't even realize they've been robbed. That's the trap, and it's already closing. The pattern is clear. 1929 showed us what happens when the banking system collapses and the government lets it fail. 2026 will show us what happens when the banking system collapses and the government refuses to let it fail. Both outcomes destroy wealth. One is visible, one is invisible, but the result is the same. Your money disappears. If you want to understand exactly how to position yourself before this happens, if you want to see the moves that protect you when everyone else is panicking, then subscribe to Economy Time Machine right now. Because the crisis isn't hiding in some distant future. It's written in the pattern, and the pattern says it's coming in 2026. Subscribe now, and I'll show you exactly what to look for and when to move. I'll see you in the next one.